Ever wondered how billionaires manage to accumulate massive amounts of wealth without paying taxes? Today, I'm going to reveal the secret strategy they use, the buy, borrow, die method. This allows them to grow their fortunes and avoid taxes entirely. And so stick around and I'll show you how you can use this strategy too and potentially never pay taxes again. Most people aren't aware of this, but a significant portion of the wealth accumulated by billionaires goes untaxed. Today, I'm going to share how you can leverage the buy, borrow, die strategy to achieve the same tax advantages that the ultra rich do. But let me explain why this strategy is so powerful. But before I do so, let me just quickly introduce myself if it's your first time watching. My name is Navi Miraj, and I'm a CPA and tax strategist who helps entrepreneurs just like you save thousands of dollars in taxes. I do this by creating free content right here on social media and through a course that is available on my website at navimirajcpa.com. More on that later. Having said that, let's jump into the video. Okay, let's break this strategy down. While the average American sees their tax bill increase as their wealth grows, many billionaires experience the opposite effect. Some of the wealthiest individuals in the world manage to pay almost nothing in taxes, while others are stuck paying as much as 50% of their income when you account for both federal and state income taxes. Some of you might resonate with what I'm about to say, but for the most part, this is what nobody understands about how the rich play the tax game. So, how do you pull this off? It all comes down to understanding how wealth is taxed versus how income is taxed. And it's simpler than you might think. You see, taxes are assessed on income. So if you can sidestep income, you can sidestep taxes. Conversely, when you acquire assets that appreciate over time, that growth isn't considered income. And when you borrow against those assets, it's not considered income either. And get this, when you pass away, the transfer of those assets to your heirs isn't treated as income either. It's fascinating that more people don't understand this concept. On the flip side of things, selling assets or earning wages counts as income. But if you deploy the buy, borrow, die strategy, this enables you to build your wealth, access cash when you need it, and minimize your tax liability and pass on the wealth to the next generation without triggering a tax bill. Stay with me on this for the next minute and you'll see how this all works. Hopefully you're with me so far. That was a high-level overview, but I'm going to guide you through this strategy step by step. So let's go ahead and dive in. Step 1, acquire appreciating assets, or AAA as I like to call it. This could include stocks, cryptocurrency, real estate, cash value life insurance, even a business you want to start or buy. The key is that these assets need to appreciate in value, and here's why. When your assets increase in value, two things are occurring simultaneously. First, your wealth grows as your assets appreciate. And second, as long as you hold on to those assets, you won't owe taxes on their appreciation. In other words, if you don't sell, you won't be taxed. This is why the ultra wealthy are sitting on over $8.5 trillion in unrealized capital gains. They hold on to their assets, avoid selling, and use them as leverage to finance their lifestyle and future investments. This is what few people understand. It's all about keeping that wealth growing while minimizing taxes. For example, one of my clients, Daniela, is saving at least $30,000 per year in taxes using similar strategies that allow her and her husband to accumulate equity in their business while reducing their tax liability. You could achieve the same by starting to work towards acquiring assets and building your portfolio. Ideally, you should focus on assets you can hold for long term, like index funds or Bitcoin. Some people may prefer building equity through business or real estate investments. The method isn't as important as the principle. To leverage this strategy, you need appreciating assets. Once you have them, you can move on to the next step. Step 2 is leverage your assets through borrowing. When you want to extract money from your investments, you generally have two options. Option 1, sell your assets and pay taxes on the gains, or better yet, option 2, leverage your assets and pay zero taxes. Borrowing against your assets has several attractive tax benefits. First, the proceeds from the loan aren't considered income, so you don't owe taxes on them. Second, by borrowing rather than selling, your assets remain invested, allowing them to continue to grow. For example, let's say you have $1 million stock portfolio and you need $300,000. If you sell $300,000 worth of those stocks, you're left with less capital in the market, potentially reducing your overall returns. But if you borrow against your portfolio instead, your investments remain intact, allowing your returns to be higher over time. And the benefits don't stop there. You can also reinvest the proceeds you borrow. In other words, you can use borrowed money to purchase even more assets. For instance, let's say with $1 million in stocks, you could take a $500,000 loan against them to buy an additional $500,000 in stocks, increasing your total capital at work from $1 million to $1.5 million. This strategy is very common in real estate, where people use equity in one property to finance the purchase of another. You might resonate with what I'm about to say, but real estate investors practically brag about the amount of debt they have. The same applies to businesses. Build equity in one, borrow against it, and acquire more businesses. Having said that, it's always important to consider the risk associated with borrowing. If your portfolio declines in value, you may be required to repay the loan or risk losing your assets as collateral. This is how I would like us to proceed with this sort of situation here. Just keep in mind, if you go this route, careful consideration of the risks, the costs, and potential outcomes is essential. So how do you borrow against your assets, right? You might be wondering that. It depends on what you own. If you have a brokerage account, you can use a securities-based line of credit. If you own real estate, a mortgage or home equity line of credit is also an option. Business owners can use a business line of credit or secured loan. And if you have a life insurance policy with cash value, you might be able to borrow against it tax-free. It's crazy, right? But I'm not even finished yet. We need to complete this strategy by passing our accumulated wealth to our heirs, tax-free. So step 3, passing wealth to your heirs. When you pass away, your heirs will inherit your assets, and the following is going to occur. Your heirs will receive the assets at their current market value, not the value you originally paid. And so this is effectively eliminating the capital gains tax you would have owed if you were to have sold when you were alive. For example, if you bought assets for $150,000 and they're now worth 30 years later, $1.5 million when you die, selling them during your lifetime would result in a $1.35 million capital gain. But under the buy, borrow, die strategy, your heirs inherit the assets at the $1.5 million market value. And if they sell them immediately, they pay no taxes because of the step up in basis that is occurring. You might be thinking, but Navi, what about estate taxes? Well, here's the thing. Federal estate taxes currently only apply to estates over $13.6 million for individuals or $27.2 million for married couples. If the value of your estate is below these amounts, you won't even have to worry about it. Even if your estate is subject to these taxes, there are strategies to minimize or avoid them altogether, such as using various types of irrevocable trusts. That's a topic for another day. As I mentioned earlier, I teach entrepreneurs just like you how to save thousands of dollars in taxes by implementing tax strategies similar to the ones mentioned in this video. Imagine joining Daniela, who I mentioned earlier, who saved over $30,000 in her first year, or Jeff, who is now saving over $25,000 annually, or Valerie, another student, who saved over $10,000 in just the first year of implementing these strategies. And there are plenty of other cases who have saved, $11,000, $6,000, or even $4,000 in their very first year of doing business. The reason these results are possible is due to my unique 3-step process to unlock your tax savings. The first thing you do is you build a strong foundational understanding that will allow you to understand how business taxes and accounting fundamentals work. So once you know that, you'll understand how your business should operate. Then you're going to learn powerful tax strategies, and nothing is held back. You'll discover how to save thousands of dollars with an S corporation, hire your minor children to save on taxes, and even contribute over $60,000 to your retirement accounts. Finally, you'll implement these strategies with me, side by side, step by step, using QuickBooks, ensuring you save every dollar possible. And here's the best part. Most students complete the course in just a few weeks. You could be on your way to massive tax savings in just a matter of 30 days. Whether you're a brand new entrepreneur or running a business with over $1 million in revenue, the course is designed for you. Plus, I offer a 30-day money-back guarantee, so no questions asked, all the risk is on me. So if you're ready to start saving thousands of dollars, visit my website at navimuradcpa.com or click on the link in the description below to learn more and preview the course content. So with that said, would you consider using the buy, borrow, die strategy? Let me know in the comments below. Just remember, playing with debt or leverage can be dangerous. You have to be sure you know what you're doing. If you have specific knowledge in an investment or industry that other people aren't aware of or have taken the time to learn, That's fine. But you can get burnt if the market takes a turn on you and the borrower requires you to pay the debt with little to no notice. Okay, so keep that in mind. If you learned something in this video, subscribe to my channel and click on the notification bell so you'll be alerted when the next one is released. Or if you can't wait and you want to learn more right now, click right here to watch another one of my valuable videos. I'll see you there or in the course.